This is the second part of a balance sheet. These are going to be your liabilities, and we're going to specifically go over current liabilities today. And I'm going to go through what is in these current liabilities. We have five categories on our balance sheet. We have accounts payable, we have accrued expenses, we have accrued payroll, we have our current portion of long-term debt, and we have unearned revenue. We're going to go through each individual piece. First category is accounts payable. These are invoices that we have entered into our accounts payable module, our accounts payable software, whatever we're using to track invoices that need to be paid. Now, these invoices at the balance sheet date have not been paid, but entered. So no cash has exchanged hands with the vendors or whoever we're paying. Accounts payable, we're using General Ledger Code 2000, and this is just a very simple aging schedule. 0 to 30, these are going to be my current invoices that we need to pay. 30 to 60, these are invoices, maybe I just have some favorable terms and I'm not paying them right away. Maybe I'm disputing it with a vendor. 60 to 90 days, maybe I have some really favorable terms with the vendor, or maybe there's a dispute I'm having with a vendor and I'm not ready to pay them until we resolve that dispute. 90 plus, I don't have anything in there, for a total of $1.5 million of accounts payable as of the balance sheet date. Our next category in current liabilities is accrued expenses. Accrued expenses, these are going to be invoices that we have not entered into the accounting software, or we might not even know exactly how much we need to pay. Maybe we have an estimate, but we know we've incurred those expenses, and we want to make sure we put those expenses in the income statement and also as a liability on the balance sheet. And in this scenario, we have two general ledger codes, 2100, miscellaneous payables. These are just going to be items that we know we've incurred. They're an expense, they should be an expense on our books. And then taxes payable, GL account 2200. These could be tax estimates. Maybe we're working with our tax accountant who provides a entry on how much taxes we owe for a particular quarter or for the entire year. We could be booking an estimate, or we could be booking exactly what we need to pay related to taxes payable, whether this is federal taxes payable or state taxes payable. And with accrued expenses, these are normally going to be a journal entry that gets posted. There's typically not going to be an automated process that's going to necessarily put this journal entry, at least from my experience, put this expense on your books. So more than likely, these are going to be manual journal entries that you book in your accounting system, so you properly reflect those expenses on your income statement and the liabilities on your balance sheet. Third category is accrued payroll. The four categories that we're working with: 2400 wages payable, 2410 commissions payable, 2420 bonus payable, and 2430 payroll taxes. Now, this is going to be compensation that has been earned in the period that we're reflecting in the financial statements, but has not been paid. That's why we're putting it in the current section of our liabilities. It's owed, but the cash as of the balance sheet date has not gone out the door. Wages payable, more than likely, it's going to be salaries. These are folks that have earned their wages or their salary, but we have not actually paid them yet. More than likely, the payroll cycle is going to be after the balance sheet date. That's why you would have this liability out there. Commissions payable, want to make sure any commissionable revenue sales that we're recognizing also has a corresponding commission expense if somebody's owed a commission due to that sale. So that's why you have commissions payable here. Bonus payable, this could be a bonus that is earned as of the balance sheet date, but has not been paid. And then payroll taxes, this is going to be a piggyback of all the different categories. These are payroll taxes that are associated with items that we need to pay. We just have not incurred the payroll expense yet. Once the cash goes out the door, the payroll taxes will follow suit with the net pay that is owed to the employees, whether it's commissions, bonus, or salaries. Our fourth category is current portion of long-term debt. Normally, you're not going to put your long-term debt in current liabilities, except for what is due within the next year. So we have two GL accounts here, 2900 and 2910. We have two bank loans, and each of these bank loans is going to go out more than 1 year. But we do want to encapsulate, or we do want to capture the principal that is owed within the next year we're going to pull that out of non-current liabilities, which we'll go through in a different video. Anything that's over a year, you're going to keep in non-current liabilities. Anything that's due within a year, you're going to put in current liabilities. So you're just isolating those 12 months and putting that portion of principal into current liabilities. And our last category is going to be unearned revenue. We're using GL account 2500, deposits received in advance. These are customers and clients that have given us money ahead of receiving their goods and services. So we have not earned the revenue associated with the cash. So that's why it's a liability. The journal entry you're going to see with this, you're going to debit your cash account, and then you're going to credit this 2500 unearned revenue or deposits received in advance. It's a liability until it's earned. Once it's earned, then this becomes company cash, and you're recognizing the revenue associated with that cash. This is also known as deferred revenue. Unearned revenue, deferred revenue basically mean the same thing. Just to give an example in here, let's say you have a deposit you're putting on a car, but you have not received the car yet. That deposit for the company receiving the cash, they have not earned the revenue because they have not provided the car yet. So for them, that deposit is unearned revenue. Once they deliver the car and you pay for the car, then they can recognize that deposit as revenue for providing the goods and services. All right, that's 5 current liabilities that you may see on a balance sheet. I hope this helped you better understand what current liabilities are. These are liabilities that are due and expected to be paid within a year. Appreciate spending time with you going over a portion of the balance sheet. Hope you have a good rest of the day, and I will see you in the next video. Take care and goodbye. Yeah.